All right, so today we're going to talk about the index fund. We're going to talk about ETF. What is the ETF? Why investors, are attracted to the ETF? So let's say you're an investor, you decide to put your hard-earned money into a stock market. You like the company, let's say a Meta, a Facebook, and then you decided to put your $10,000 into a stock market in Meta. In the all, so that is you buying individual company. So there is a risk associated with the buying individual stock. Let's say, for example, right now, the Meta is trading close to 712 or something. Just let me take a look. Um, let's go into Yahoo portal and let's see, go to finance, and then let's look at the Meta. So here we go. So right now is Meta is trading close to $717.51. Well, 716, little down after market. So anyway, let's say you decided to put entire $10,000 into buying Meta stock. So basically you have close to, you will have, let's say 10,000 divided by 717, close to, let's say 12 or whatever number of stock you can buy with your $10,000. And tomorrow some bad news come out, right? Tomorrow some bad news comes out, and then all of a sudden, individual stock like a Meta might go 10%. That means like within the day that you invested yesterday and today, like you'll be losing close to $1,000. I'm close to $500. You're like, oh no, it took so long for you to collect that $10,000, and just within hours, without sometime, stock market moves so fast, the news and all those things, within hour or a minute you will be losing a lot of money. But keep in mind that in the long term, most of the US companies, you might make money in the stock market. But some of the companies that exist today might not even be existing tomorrow. So there is a risk always associated with investing in this individual stock market. So what is there that is kind of not as risky? See, the thing about investing is like is always there is a risk. There is maybe the overall US market or the world market go down in that year, it doesn't really matter what you invest in. Most of those things, for example, you think about 2008 financial crisis, right? Anyway, so without the worst thing is like not investing at all. The way the things are right now, all the inflation and everything, so you have to invest your hard-earned money. Basically, the money has to earn more money. So that is the whole idea about investing. Anyway, so let's talk about ETF. So what is ETF? So ETF they call is an abbreviated form ETF, basically exchange traded funds. So the idea is like just like you can when you go to your brokerage, just brokerage such as Fidelity or Charles Schwab or whatever, you can buy just like you can buy the individual stock like a Meta or maybe Apple or whatever. Just like that, you can buy the ETF also. So just like all these stock market company has the ticker they call, for example, Meta or Facebook, this is META. Just like that, every ETF has the ticker associated with it. For example, the SPY, those are the most popular that I have listed here, for example. Um, SPY basically it targets. Behind the scene, you have to keep in mind that all of these ETF, behind the scene, they keep tracks of the underlying security. In this case, in the case of SPY ETF, it targets entire stock market S&P 500, which is the most popular index used by the most of the user, right? So basically, if the S&P 500 goes up, your investment also goes up. If the stock market goes down, it also goes down. So basically, it basically tracks the entire 500 S&P 500. But however, just like there is large big cap companies, there is something called weighting. Weight. For example, even though you're investing in SPY, but like your weight on Apple might be higher than compared to little company that's unknown. Not really unknown, but it's there, but it doesn't have that much name recognition as Apple or Meta or Microsoft or stuff like that. So the whole idea is that there is a weight. Some bigger companies have bigger weight, so smaller companies have smaller weight. Okay, most of the time, like if you look at the weighting of the SPY, most of them is like all the popular big companies. They have higher weighting, such as like a Meta or Apple or Microsoft, and all those Johnson and Johnson, all those have higher weighting. Anyway, so the thing to remember is like just like a stock market, it has a ticker, and you can buy in a stock market ETF, and then it day to day basis it goes up and down. Just imagine sort of like stock market. That and then so so why the ETF are popular? Because like as a new investor, people are not we are not as human being, we kind of like trained to take a risk, or you know what I mean, when the issue occur, or like we see some sort of when people a lot of people selling, we feel like, oh, you know what, I have to sell it too, instead of because that's how we from the beginning, as we evolve, that's how we have been taught. But in the stock market we have to just do the opposite. But I know it's just easier just saying it, but when you have to deal with it, because our emotion kicks in rather than our rationale, when the stock market goes down. So to avoid all of those things, hey, why should I worry about individual day to day stock market goes up or down in the company that I have invested, rather than doing that. So you basically invest in SPY or QQQ or whatever. Those are like ETF. But of course, just like ETF, in the past, if you buy any stock, you'll have to pay the commission. But like this day, because of the thank you for the Robinhood, most of the brokerages, either Fidelity or they have reduced. You don't have to pay. They don't have like buying fees or stuff like that. You started with the Robinhood, retail investors and everything, and now most of the brokerages, you can buy individual stock free. However, when you buy so when you buy ETF, you have to consider about the expense, the expense must, because remember, like, nothing is free in this world. It has to manage by some companies. So there is something called expense ratio. Okay, those are some of the things that you have to know about it. And then the risk is very low in the ETF because it's been diversified. Chances of all U.S. companies going down is way, way, way lower compared to one individual companies. As you might have heard in the news, individual companies go down, go up, go down. The company that existed 10 years ago might not be even existing right now, or even if it exists, their value has been so diminished. There's a risk, right? That is that. Okay, now we have a basic idea about what ETF is. Let's go ahead and talk about. Today I want to talk about this individual stock. A lot of retail investors are investing, and I can see those kind of videos, and then in Twitter, in the TikTok or whatever. So instead of, when you hear about, oh, you know what, I made a lot of money on this stock, let's say this ETF, SCSD or whatever, but like I want you to do research of yourself, know what it is before buying. Just don't follow anybody just randomly. Okay, let's go and talk about this specific ETF. So, so what happens is that this ETF is popular because it pays large amount of dividend. For example, if you go into Yahoo portal and take a look, this is Charles Schwab U.S. Dividend ETF, and then let's look at how much it pays. People are attracted because it pays dividends. Here is the yield. So basically, yield in the stock market is just the dividend that returns. So if you invested $100 in this ETF, assuming you invest $100, end of the year it pays you close to 4% or $4, right? Just to make a simple example here. So it is popular because it pays you the dividend. The way we make money in the stock market is the capital appreciation of the stock market. As the time passes, it goes up. So however, saying that, let's see, here is this ETF. Let's see how this ETF is doing last 5 days. When you invest, you don't really invest, but these are like a long-term investment. You don't worry about like what happens in 5 days, what happens in a month, what happens 6 days, maybe let's say year to day. So there is a reason why, even though stock market, remember, like if you guys remember it in around like when the President Trump's tariff started around April, whatever, everything was down close to 25%. Market totally recovered. However, the performance of this guy is not that good in year to date, 0.37. I will talk about why that is. At the same time, let's see, 1 year is 4%. But as you go into long term, as I said, it basically improves in last 5 year, or maybe go so like a 200. All if since its inception, it's a rate of return, not rate of return, total return. If you keep on investing, since I think its inception was around 2011 or whatever when it came out, and then up to now, you would have made 227%. Doing nothing, of course, paying the expense that you have to pay for the company. Okay, so that is that. The reason this is popular is, let me show you the why it's popular. So remember, like ETF is a combination of all the different kind of asset. For example, in terms of this ETF, it basically it comprises all these individual stock. For example, here's a Texas Instrument, Chevron, ConocoPhillips, all of them. And then this is the weight. How much, let's say, out of $100, close to $4.37 is invested into Texas Instrument. If by looking at this example, most of the weight and all of these company right here, these are big American, kind of like the blue chip type of companies in different sectors. But however, they are focused mainly on what you call mainly they focus on mainly focus on the industrial, and then like consumer staples and stuff like that. Okay, the other reason why you need to invest, it is good idea to invest or not, it's up to you, like but I want you to learn what it is. Just randomly you look at something in TikTok, somebody recommends you, don't go and invest. Learn about it. Learning is the most important thing. So according to this Charles Schwab website, this is their rate of return. Let's say you invested for 1 year, rate of return is 6%, 6.10%, which is not great. But at the same time, what happens like this, you get all this dividend. This is including dividend. It's not like just as the appreciation of your underlying stock. As you already saw from this list right here, um, these are not really like growth companies. You know what I mean? Like these are like staple American companies. They pay the dividend. They don't grow that much, but however, they appreciate in some range. Sometimes some year 4%, sometimes 5%, with a low risk. Just by looking at it, most of them are like, some technologies are there, unlike technology companies, which goes up and down, so frequently, and they also give there is a risk involved. At the same time, they provide big reward. There is nothing free in this world. You have to know the risk and reward is always there. That's by looking at the list right here, the companies list right here. As you can see, these are like a staple U.S. company, right? Bristol Myers, Home Depot, that we know, that we use every day, Verizon, Coca-Cola, this Home Depot, Altria Group, I think that's a Marlboro or whatever, that those companies, and gas station that we go daily, and then Texas Instrument, for example, the calculator our children use, we use. Anyway, so those are the staple company. That's why they give you the dividend, because hey, otherwise, why somebody would put their money and your stock doesn't really do that great, unlike the technology company or fast growth company, and just wait for the 4% dividend. Okay. Anyway, so that is about that. So basically, what happens is like, so average annual rate of return in this ETF. Always look for the numbers and the fact. Let's say in 1 year they're saying, okay, you know what? If you put like $100, you will have $106. That's not great. I mean, if you look at the other some companies, for example, Fidelity, if you just put your money, they also give close to 4 or 5% there, without any risk. But this one has, of course, risks, right? ETF is not risk free, like I said earlier. If the underlying, stocks goes down, or the U.S. economy goes south, or entire world economy is not doing great, we fall into recession, or whatever, it could happen. There's always risk, but risk is mitigated because of the diversification, meaning like We are investing in so many diversified sector with, even though one company goes down, goes bankrupt, we have no impact. That's why most of the people and then are kind of like attracted to this kind of stock. So anyway, so this is really good stock if you like the dividend and if you do not want to take a risk and stuff like that. But however, the capital appreciation or this appreciation of your stock is not that much or individual. I mean, so like I said, it has both pros and cons. Based on that, you can decide. Anyway, I'll continue to make videos on different kind of sector. Next, I will create videos on S&P 500 stock like ETF, like SPY and QQQ, and why we should or POO. We'll talk about that. Anyway, guys, thank you so much.